KVB PRIME, developed for global traders, growing together with you.
Good evening and welcome to KVB Prime Weekly Market Commentary. This week's topic is, will oil become free of charge? We'll begin by looking at oil prices crash. Oil prices has experienced a volatile week. Last Monday, OPEC members reached a reduction agreement on production, resulting in an expectation on a price boost. Suppliers agreed to reduce output by 9.7 million barrels per day for May and June. It is the largest reduction in agreement in history. However, the reduction was unable to match the rapid drop in demand due to the pandemic. Oil prices fell continuously. On another note, the agreement period was only 2 months. In such a short period of time, it is unlikely to restore the oil price. This Monday, oil prices dropped significantly, reaching $11 per barrel. As oil storage are expected to run out in May and demand remains low, the May future contract for US oil benchmark even went below $0 per barrel to mark historic decline. The long position holders will need to either sell these contracts or take physical delivery of the oil by May. But since the holders are not eager to take the delivery, they must dump their oil now, regardless of the price. Analysts expect more pain to come in the oil market. Even Brent oil could collapse if global storage worsens in a faster pace. Now let's look at weekly highlights. This week's highlight are USD appreciated 0.26%, Euro fall 0.57%, Japanese yen fall 0.80%, WTI fall between 21 to 24%, Brent oil fall 7.62%, Dow Industrial and SP 500 climb over 2%. Now let's look at WTI. WTI is currently in a clear downtrend channel. The month of April so far has been continuously fluctuating downflow, with the only exception at the beginning of the month where the market experienced a rebound. Due to COVID-19, population around the globe enters lockdown, affecting logistics, thus resulting in oil supply larger than volume demanded. Last week's reduction agreement did not affect WTI prices. You only achieve a temporary slow in the drop. On Monday, oil prices historically opened on a trading gap to 11.38. This was due to oversupply and the transfer of position contract at the deadline of 21st of April. When it comes to transfer of position, oil prices are resettled, resulting in a large potential of opening on a trading gap. If conditions of COVID-19 have no signs of recovering, the support 11.38 will not be able to defend the fall of WTI prices. Now let's look at USD. The market trend for USD for the past 2 weeks are fairly similar. The predicted support and resistance last week applies to this week as well. Thus, the key is to monitor the upper resistance 101 and the lower support 98.3. As we said last week, there is a growing demand for USD. Technically, as long as the market doesn't fall below the support 98.3, the overall uptrend for the past 2 years will not change. The narrowing price boundary will be our focus this week, where opportunities are created when the market opens the boundary. On a weekly basis, USD has completed its uptrend for the past 2 years, now coming below the key resistance 103. The recent test did not break open the resistance and the market enters cooldown at 98.3. It is holding power at this position for another attempt on the resistance. Intraday, traders should monitor the potential for the next attempt and the possibility of breaking open. Once it is opened, USD will appreciate in a manner where there is no technical resistance in preventing buyers. In other words, upper resistance will decrease dramatically. Now let's look at Euro. Euro last week experienced adjusting fluctuation within our known zone. Comparing 2 weeks ago, last week's trend was similar. The predicted support and resistance 1.1150 and 1.0760 will extend into this week, where the market will adjust within the boundary. Similar to USDX, Euro's boundary are also getting narrower. Thus, the key for this week is the strength of the support 1.0760. Overall, Euro is still in the downtrend channel over the past 2 years. As shown in the graph, every time a support is opened, it is an opportunity to short. As long as the market doesn't break the resistance 1.1150, the potential for a rebound is limited. Hence, the ideology of short on high is an appropriate trading strategy. Now let's look at British pound. The focus for pound this week is 1.2650 and 1.2450. When one imbalances, the second resistance and support will become the next focus. This means when pound opens 1.2650, it will have high potential on touching 1.2750. Otherwise, when pound falls below 1.2450, traders can short until 1.2160. At the same time, the upper resistance 1.2750 is a strong position. Pound will need quite an effort to break open this resistance. At the end of March, pound experienced a large V-shaped rebound. This hints the rebound strength of a long rebound. However, there are still strong resistance ahead of British pound. The current prices are still experiencing a fluctuating downflow, thus buyers will need to take care. Now let's look at the gold market. After gold created a 7-year record high of 1,747, he enters cooldown. The climb in gold prices was expected. Due to the outbreak of coronavirus, fluctuating in gold prices was somehow surprising. The strong support 1450 provided the foundation for a V-shaped rebound. The potential opening of the resistance 1754.5 is a key for the uptrend to be extended. However, will the market enter cooldown between 1560 and 1642 remains unknown. How long will it stay in the cooldown zone is also uncertain. The trading strategy is to focus when the market is above 1642 or when it is above the support line on the chart. At last, we'll look at crude oil. Outbreak of COVID-19 resulted in a decrease in demand of commodities. The strong demand of USDX and the price war between OPEC members and non-members resulting crude oil market to remain as a threat, creating a record low in 18 years. WTI was adjusting itself between the resistance 32.2 and the support 25.2. On Thursday and Friday, the market had multiple tests on the support 25.2, however, failed. Hence, it remained as a key for this week. Overall, after creating a record low, WTI still have the potential for a further fall. Technically speaking, the closing and the monthly candlestick graph for March predicts a high potential in the fall in April. Talking about prices, 32.2 is the first resistance position, followed by 36.6. These two resistance position is fairly strong. Thus, when the market is below the two prices, there is a limited potential for potential appreciation. Otherwise, when falling below 25.5 or 20.5, WTI will continue to fall. Okay, that's all for this week's KVB Prime Weekly Market Commentary, and we'll see you next week.